Good evening, and welcome back to SleepWise. Tonight, we drift into the history of banking, not simply the history of money, but the history of trust, of promises written down, of wealth carried across uncertain roads, and of ordinary human beings asking a quiet question that has echoed for thousands of years. If I place something valuable in another person's hands, will it still be there when I return? And before we begin, if SleepWise helps you slow the mind and soften the day, do consider following and sharing the channel with someone else who might enjoy falling asleep while learning something new. Now, as we settle into the story, it helps to begin with a simple thought. Banking did not begin as an industry. It did not begin with towers, marble halls, or even printed money. It began as a response to uncertainty. Grain could spoil, silver could be stolen, trade could take months, and memory, however honest, could fail. So across the ancient world, people built systems to store value, record obligations, and retrieve what had been entrusted to others. In Mesopotamia, some of the earliest financial records were pressed into clay tablets. These tablets tracked grain deliveries, silver payments, debts, rents, and temple obligations. Temples and palaces often served as centers of storage and bookkeeping, partly because they were powerful and partly because they seemed stable enough to anchor trust. The earliest banking world was not yet a bank in the modern sense, but its outline was already visible. Deposits, accounts, obligations, and institutions whose authority helped make promises believable. Later, in the Greek and Roman worlds, money changers and lenders became familiar figures in markets and ports. Coins arrived from different cities with different weights, images, and metal content, and someone had to judge their value. Merchants needed exchange, safekeeping, and credit. Seaborne trade created its own financial logic, because a ship might return with profit or sink beneath the water and vanish. Interest was one way of pricing that uncertainty, the cost of time, danger, and distance. And yet this early financial life remained local and physical. Value moved slowly, often as metal. Information traveled only as fast as a horse or a sail. Trust rested on family reputation, religious authority, civic standing, and the memory of communities. Banking lived in storerooms, in ledgers and tablets, and in the patient hands of scribes. But history rarely stays still for long. As trade revived and cities grew busier, the old habits of lending, counting, and safekeeping began to gather new sophistication. Soon, in the merchant cities of Florence, Venice, and Genoa, banking would become something sharper and more recognizable. A system not only for guarding wealth, but for moving it across borders, across generations, and eventually across the world. The world slows, and so do we. By the late Middle Ages, the old financial habits of the ancient world had not disappeared. They had simply been scattered and reshaped by time. Trade narrowed in some places after the fall of Rome, then slowly revived through fairs, ports, and caravan routes. In market towns and coastal cities, merchants again faced a familiar problem. Goods were moving farther, deals were growing more complex, and carrying metal across long distances was dangerous. Commerce needed something steadier than memory and safer than a sack of coins. So the story gathers itself in northern and central Italy, where Florence, Venice, and Genoa became fertile ground for financial innovation. These were commercial engines tied to wool, silk, spices, shipping, and diplomacy. Their merchants bought and sold across the Mediterranean and beyond. They settled accounts across borders and needed ways to move value without always moving gold or silver by hand. This was the world in which banking became more recognizably modern. Merchant families built houses that did more than trade cloth or arrange cargo. They accepted deposits, extended credit, converted currencies, and maintained networks of correspondence with partners in other cities. To finance trade was to understand risk. To hold deposits was to understand trust. To keep accounts was to understand the delicate line between promise and payment. Even the word bank has roots in this commercial life. It is often traced to the Italian banco, meaning bench or counter, the place where money changers conducted business. The image is fitting: a wooden surface in a public place, coins being counted, notes compared, letters opened, and behind it all the quiet labor of judgment. Venice, with its maritime empire, became a center of long-distance commerce and public finance. Genoa was tied to shipping and credit. Florence became associated with banking families whose influence stretched far beyond Tuscany. In these cities, finance was no longer just a local convenience. It was becoming an organizing system for trade itself, a way to connect distant markets, smooth transactions across currencies, and let commerce travel more lightly than metal ever could. And because all of this rested on trust, reputation became a kind of invisible currency. A merchant house with a good name could extend its reach astonishingly far. A damaged name could bring the whole structure trembling down. Long before regulators or central banks, the most valuable asset in banking was not cash in a vault. It was belief, the shared conviction that a promise written in one city would be honored in another. In Renaissance Italy, the old world of lending and safekeeping was being refined into something more agile. Banking was stepping out from the shadows of trade and becoming one of the engines of urban life. In the merchant cities of Renaissance Italy, banking began to feel less like an old habit and more like a system. Florence, Venice, and Genoa were alive with cloth, spices, ships, taxes, and diplomacy. Merchants no longer dealt only with neighbors they could see and judge in person. They dealt with distant buyers, foreign currencies, delayed shipments, and promises that might need to survive long journeys and uncertain seasons. In such a world, finance had to become more elegant. Florence became especially important because it was home to merchant banking families whose influence reached far beyond the city itself. The Medici are the most famous, but they were part of a wider culture in which banking houses accepted deposits, financed trade, converted currencies, and kept complex relationships alive across multiple cities at once. Wealth was no longer simply stored. It was tracked, translated, advanced, and recalled through networks of trust. And as this world grew more intricate, it needed discipline inside the books. Here, softly and almost without drama, enters one of the quiet minds of financial history, Luca Pacioli. He was not the inventor of commerce, nor the first man to keep accounts, but in 1494 he described double-entry bookkeeping in a form that helped give structure to a changing world. Every transaction properly recorded had two sides. What left one place entered another. What was received somewhere had been given somewhere else. The books, if carefully kept, could begin to reveal the hidden skeleton of a business. This mattered far more than it may first appear. A merchant house could now see more clearly what it owned, what it owed, what others owed it, and whether its apparent prosperity was real or imagined. Errors became easier to detect. Confusion became harder to hide. A banker in Florence, leaning over ruled pages under candlelight, could make distant trade legible through columns of ink. So banking in Renaissance Italy became a marriage of trust and measurement. Reputation still mattered deeply. A great family name could open doors that no ledger ever could. But the ledger itself was becoming a source of authority, a way of disciplining memory, organizing complexity, and turning the movement of goods, coin, and credit into something that could be understood. This was the real magic of the moment. Banking was ceasing to be only a matter of safekeeping and lending. It was becoming a way of seeing, a way of holding together a world in motion. And once money could be organized this carefully on paper, it became easier to imagine that value itself might one day travel more as writing than as metal. Beyond the noise of markets and politics, that patient clerical order gave banking something precious: continuity. A promise could now outlive the moment in which it was made. From Italy, the center of financial gravity, gradually began to move north. Trade widened, ships traveled farther, and Europe's commercial life became more deeply tied to oceans, empires, and large urban markets. In this new setting, one city rose with unusual force: Amsterdam. It was a port of extraordinary movement, where goods, information, and coin from many different places met in restless abundance. That abundance created its own problem. Merchants were dealing with a bewildering mix of coins, each with different origins, weights, and metal content. Some were worn down, some clipped, some trusted more than others. For a busy trading city, this was not merely inconvenient, it was costly. Every uncertain coin introduced friction into commerce, and friction, multiplied across thousands of transactions, could quietly slow an entire economy. The Bank of Amsterdam, founded in 1609, was one of the elegant answers to that problem. Merchants could deposit coin and receive credit on the books of the bank. What mattered then was not the endless inspection of each individual coin in each individual transaction, but the trust placed in the institution's recorded balances. Account money, held in a respected ledger, could be cleaner and more dependable than piles of metal changing hands again and again. There was something almost modern in this shift. Value was becoming less tied to the physical inconvenience of coin and more tied to the credibility of records. A merchant settling accounts did not always need to touch silver to move wealth. He needed confidence in the books, confidence in the institution, and confidence that others would accept those balances as sound. Amsterdam, therefore, represented more than a prosperous city. It represented a new stage in banking's long transformation. The ledger, which had helped organize private commerce in Renaissance Italy, was now becoming part of a wider public infrastructure for trade. Banking was turning into a civic technology, a way to reduce confusion, increase trust, and let commerce move with greater speed and precision. And still, as always, the system rested on belief. If enough merchants trusted the institution's records, those records became immensely powerful. If that trust weakened, the elegance would begin to fray. The world of banking was growing more abstract, more efficient, and more scalable. Value no longer needed to travel only in the form of metal locked in chests and loaded onto ships. Increasingly, it could travel in balances, claims, and entries on a page. Soon, states would take a deeper interest in this power, because if trust recorded in ledgers could support trade, perhaps it could also help finance governments, wars, and the ambitions of nations. Once governments saw what organized finance could do for commerce, they began drawing it closer. War was expensive, and rulers often needed money before taxes arrived. In England, this need helped give rise to one of the most consequential institutions in banking history, the Bank of England, founded in 1694. Its origins were tied to public borrowing and the funding of war, but its significance reached much further. It stood near the growing intersection of state power, credit, and public trust. Around the same broader world, goldsmith bankers were already teaching society another lesson. Goldsmiths had secure vaults, so people left coin and bullion with them for safekeeping. In return, they received receipts. At first, those receipts were simply claims on stored metal. But practical life has a way of changing the meaning of things. If a receipt from a trusted issuer could be redeemed for coin, then others might accept that receipt in payment. Slowly, paper began doing some of the work of money. This was one of banking's great transformations. Wealth no longer needed to appear only as metal in the hand. It could appear as a promise backed by a reputable institution. And once paper claims circulated, another realization emerged. Not every depositor would demand their money back at the same time. A bank could keep part of its deposits available while lending another part onward. This made the system more useful because idle savings could now finance trade, enterprise, and government. But it also made the system more fragile because the promise of immediate access rested on the assumption that withdrawals would remain staggered. Here was the beauty and danger of banking in one movement. Money that might have slept quietly in a vault could instead be put to work. Economies could grow faster. Commerce could stretch wider. Yet beneath that productive elegance lived a structural vulnerability. If too many people lost confidence at once, even a bank with valuable assets could struggle to meet immediate demands. That is why bank runs have haunted banking history for centuries. They are not always born from fraud. Sometimes they are born from fear itself. One depositor hurries to withdraw because he worries others may do the same. Others see him and feel the same urgency. In a matter of hours, belief can reverse direction. What seemed safe, because everyone trusted it, becomes unsafe because too many people stop trusting it together. So banking matured through a paradox that has never quite disappeared. The more useful it became, the more it depended on confidence. The more it transformed promises into money-like claims, the more stability rested on human expectation. And with that paradox now fully alive, banking was ready to expand into the industrial age, larger, more ambitious, and more deeply woven into everyday life than ever before. By the 19th century, banking had moved far beyond the old world of merchant families balancing distant accounts by candlelight. It was still a world of ledgers and trust, but now it stood beside smokestacks, railway timetables, dockyards, mills, and growing city streets. Industrial life demanded capital long before it produced reward. Tracks had to be laid before trains could run. Ports had to be dredged before ships could unload. Factories had to be built before cloth and steel could pour from them. The future had to be financed in advance. That need changed banking. The private house built on one family's fortune and judgment did not disappear, but it was increasingly joined by larger institutions with broader pools of capital. Joint stock banks gathered funds from many shareholders, allowing them to reach a scale better suited to railways, mines, canals, and industrial firms. Banking was becoming less intimate in one sense and more social in another. It was drawing in the savings and anxieties of a much wider public. You could see this change in the cities. Bank buildings stood on prominent streets with stone facades, columns, counters, and orderly books. They were designed to reassure. The message was simple. Stability lives here. Numbers are watched here. Your small portion of the future can be left here in peace. A bank branch was not only a financial institution, it was a theater of confidence, and gradually it entered the domestic world. Savings banks encouraged workers, shopkeepers, widows, servants, and families to deposit modest sums. These were not the great movements of sovereign finance or international trade. They were smaller acts, wages partly set aside, rent money protected, a reserve for illness, a quiet hope for old age. The passbook became an intimate object, recording patience in neat lines of ink. This was one of the deepest changes in the history of banking. Finance was no longer only for rulers, merchants, and commercial elites. It was becoming part of ordinary rhythm. Payday, deposit day, bill day, the careful balancing of one week against the next. A household that opened an account was not merely using a service. It was trusting that some part of today could be preserved for tomorrow. Checks and clearing systems pushed the process further. Money no longer needed to move only as coin or folded notes. Signatures, instructions, balances between institutions and clerical routines could do more of the work. Value was becoming lighter and more abstract. Yet to many people, it felt more familiar because the local branch had become so visible. And so banking settled into modern life with a calm face and a complicated interior. A neighborhood institution on the surface, a vast machine of credit underneath. It could finance empires and railways, but it could also protect a seamstress's savings. It belonged now to the grand scale and the human scale at once. Into this widening financial world stepped one of the great banking names of the 19th century, Rothschild. Nathan Mayer Rothschild, based in London, was one of 5 sons of Meyer Amschel Rothschild, whose family network stretched across Frankfurt, Vienna, Naples, Paris, and London. Earlier banking houses had reached beyond their home cities, but the Rothschilds made something unusually coordinated out of distance. They turned geography into an advantage. Their strength did not rest only on money. It rested on correspondence, discipline, and trust carried through family ties. Each branch gathered information, cultivated relationships, arranged loans, tracked markets, and maintained steady communication with the others. In a world where news still traveled by horse and packet boat, this mattered immensely. A letter arriving a little sooner, or from a more trusted source, could alter the judgment of an entire house. Banking was becoming, more clearly than ever, an information business. Nathan Mayer Rothschild became the most famous of the brothers, partly because London itself was becoming the great financial center of a rising imperial world. From there, he helped arrange sovereign borrowing, manage bond issues, and connect governments with investors who might be hundreds of miles away from the events their money would shape. Wars, debt, diplomacy, and capital all began to meet in the same room. There are legends around the Rothschild name, stories of secret messages and dramatic early intelligence. Some have grown larger in memory than in evidence. The truer story is quieter and, in some ways, more impressive. The family's advantage came from patient organization. They built trust so carefully that their name itself became a kind of financial instrument. To borrow through them was to borrow under the shelter of a reputation many investors regarded as serious. That reputation allowed them to do something remarkable. They helped turn banking into a continental network. Capital could be raised in one city, directed toward another, and serviced through a web of letters, payments, and obligations. The house in London did not stand alone. It was part of a coordinated organism. Banking was no longer merely a local art practice behind one counter. It was becoming a system of synchronized judgment across borders. And there is something quietly modern in the image of Nathan Rothschild at his desk. Papers arriving, prices shifting, governments requesting funds, and distant borrowers depending on the confidence of investors who would never meet them. He was not simply holding money. He was orchestrating trust at scale. So he enters our story not as a decorative biographical figure, but as a human marker of banking's transformation. Through Rothschild, finance becomes larger, faster, more international, and more dependent on the disciplined movement of information through trusted hands. The Rothschild era reveals how dramatically banking had widened. By the 19th century, a banker was no longer only a lender to merchants or a keeper of deposits. He might help finance governments, place sovereign bonds, assess revolutions, follow troop movements, judge exchange rates, and watch the shifting credibility of entire states. The business had grown taller. It now stood close to history itself. Railways offer one of the clearest examples. To lay tracks across a nation required immense sums at the beginning, years of construction, and confidence that the future would justify the present. Banking, together with broader capital markets, made such projects possible. The 19th century was built not only by engineers and laborers, but by institutions willing to gather savings and direct them toward long-lived ventures. Finance became one of the hidden architectures of modernity. The Rothschild network was especially suited to this age because it combined reach with reliability. A government borrower might trust a house whose name carried weight in several capitals at once. Investors, in turn, might buy bonds more readily if they believed the arranging banker had judged the risk carefully. Banking here became a kind of translation. It translated private savings into public borrowing, distant opportunity into local investment, and scattered confidence into concentrated capital. But scale did not remove fragility. In some ways, it magnified it. If finance grew more international, then shocks could travel farther. War, harvest failure, political upheaval, revolution, and sovereign default could all weaken the value of a promise. A bond that looked secure in spring could seem doubtful by autumn. A government that appeared stable could begin with surprising speed to look exposed. And because large banking houses stood near the center of these flows, they also stood close to danger. This is what makes Rothschild such a useful figure in the story. He stands not only for wealth or prestige, but for banking as networked responsibility. The banker was no longer just a keeper of money. He was an assessor of regimes, a handler of distance, and a guardian of confidence between strangers who would never meet. There is something serene and unsettling in that image. Letters cross borders. Prices shift between capitals. Decisions made in one paneled room alter the fortunes of ministries, railways, and investors hundreds of miles away. The system is elegant because it links faraway lives. It is fragile for the same reason. By now, banking had become one of the great organizing forces of the modern world, yet its power rested, as it always had, on belief. The larger the system grew, the more it depended on the continued credibility of people, institutions, and states. And once so much depended on confidence, the age of large booms and painful reversals was never far away. The 19th century did not move in a straight line from innovation to stability. It surged, dazzled, overreached, and recoiled. New technologies, new markets, and new transport links made optimism feel reasonable. Railways spread across landscapes. Cities expanded. Industry multiplied. Land values rose. Credit loosened. For a time, prosperity seemed not merely possible, but inevitable. And in such moments, banking often became both the servant of growth and the accomplice of excess. This rhythm is one of the oldest in financial history. An opportunity appears and seems undeniable. Money flows toward it. Rising prices appear to confirm earlier decisions. Banks become more willing to lend because the world looks safer when asset values are climbing. Borrowers become more willing to take risk because tomorrow appears generous. Then something shifts. A crop fails. A war interrupts trade. A borrower falters. Interest rates rise. Rumor arrives before explanation. The future, which had seemed full of room, suddenly feels narrow. When that turn comes, banking reveals its double nature. In good times, it amplifies growth by extending credit and linking savings to enterprise. In bad times, it can amplify contraction by pulling back, repricing risk, and transmitting fear through connected obligations. The quiet branch on a respectable street may belong to a chain of exposures stretching across industries and regions. The depositor sees polished wood and a clerk. Beneath that stillness may lie rail bonds, commercial bills, foreign claims, property loans, and promises dependent on confidence elsewhere. This interdependence made 19th century crises feel both modern and mysterious. Trouble in one place could travel through payment systems, correspondent relations, and shared expectations into places that seemed unrelated. Banking had helped stitch economies together. That success meant distress could move along the same threads. A system built to circulate trust could also circulate anxiety. Private prestige still mattered in such episodes. A respected house might calm markets, extend support, or lend its name to a rescue. But as economies grew more layered, it became harder to believe that reputation alone would always be enough. The financial world had become too large and interconnected to rely on improvisation by a few men. So the century leaves us with a financial order that is both impressive and uneasy. Banking can finance industrial civilization, support everyday saving, and coordinate investment on a vast scale. Yet it carries within itself the possibility of sudden reversals. Confidence remains productive but precarious. The machine grows stronger and also more sensitive. By the end of the century, this tension was visible in the United States, where extraordinary economic energy had produced enormous financial power without yet producing a fully satisfactory center of stability. The American banking world at the turn of the 20th century was energetic and uneasy. The country was growing quickly. Railroads crossed vast distances. Cities climbed upward. factories multiplied, and capital rushed toward opportunity. Yet, beneath this expansion lay a financial structure that was powerful without being fully coordinated. National banks existed, state banks existed, trust companies existed, and clearinghouses tried to organize cooperation among them. In ordinary weather, the arrangement could function. In a storm, its weaknesses became visible. Reserves were scattered. Responsibilities were divided. Institutions did not all resemble one another, and depositors often understood less about those differences than they assumed. A trust company could feel as solid as a bank until confidence began to drain away. Then distinctions in liquidity and support suddenly mattered. The question for the public became brutally simple. Who is safe, and who will stand behind the system if too many people begin to run? Panic in such a world was never purely economic. It was social, psychological, and logistical at once. Rumor moved through streets faster than reassurance. Crowds formed outside institutions before the books could be understood. Depositors acted not because they possessed complete information, but because waiting felt dangerous. If others withdraw first, prudence may look like delay. And so a modern financial system could still be governed in fragile moments by very old human instincts. Clearing houses helped at times by coordinating banks, issuing loan certificates, and trying to conserve reserves. The Treasury could sometimes provide relief. Powerful financiers could encourage mergers or assemble emergency support. But none of this amounted to a true central authority prepared to inject liquidity when confidence vanished. The architecture of rescue still depended too much on improvisation. That made the United States an especially dramatic stage for the next chapter in banking history. It was wealthy, fast-growing, and increasingly central to global finance. Yet it still lacked a satisfactory lender of last resort. The country had built a modern economy without fully completing the machinery needed to stabilize its own banking system. You can almost feel the tension gathering in this era. Telephones ringing, runners carrying messages, newspapers feeding uncertainty, and men in dark coats moving urgently between offices while depositors lined the pavements outside. Behind the polished wood and iron counters, the same old truth was waiting. Banking had become larger and more nationally important. It had not escaped fear. Soon, that fear would crest in a crisis severe enough to summon one of the era's most formidable men into the story. J.P. Morgan, not merely as a rich banker, but as a private stabilizer in a system that had grown too important to remain so exposed. When the panic of 1907 arrived, the American financial system discovered how exposed it still was. The trouble began in a market tense already, then spread through trust companies and the wider network of confidence on which banks depended. Depositors hurried to withdraw. Lenders grew cautious. Institutions that had seemed sturdy only days before now looked uncertain under the hard light of fear. The machinery of finance, so impressive in good weather, began to seize. Into that strained atmosphere stepped John Pierpont Morgan, By then, he was already one of the most formidable figures in American finance, a man whose name carried unusual weight in railroads, industry, and banking. Yet what makes him important to this story is not simply that he was rich or powerful. It is that, in the absence of a true central bank, he became something closer to an emergency stabilizer, a private man trying to hold together a public system. The image has become almost theatrical in financial memory. Morgan in his library, bankers summoned, balance sheets examined, support arranged, pressure applied. He and other leading financiers helped decide which institutions might be saved, which mergers should proceed, where liquidity could be assembled, and how confidence might be restored before panic consumed everything else. It was not a gentle process. It was part persuasion, part command, part improvised statecraft outside the state itself. What mattered most was the lesson. A modern industrial nation had reached a point where its banking system was too important to be left to scattered improvisation when fear took hold. Morgan's intervention may have helped calm the storm, but it also revealed how strange the arrangement had become. The survival of the system could not depend on whether one extraordinary banker happened to be available, willing, and persuasive enough in the right week of the right year. There is something deeply transitional about Morgan's role. He belongs partly to the older world of dominant private financiers, men whose reputations could steady markets by force of character. But he also stands at the threshold of a newer world, one in which such personal authority would no longer be considered an adequate foundation for national stability. The very scale of his rescue showed the inadequacy of the structure around him. So Morgan enters the history of banking not merely as a titan of wealth, but as the last great private backstop of an age before central banking was organized in the United States. Through him, the old model reached its limit. The panic subsided, but the question it left behind did not. If a private banker had to act like a central bank in crisis, then perhaps the nation needed an actual central bank soon. And so, in the quiet after storm, American finance turned toward a new solution. One meant not to end panic forever, but to give the system a steadier hand when panic returned. The new solution did not arrive overnight. Americans had argued for generations about banks, money, federal power, and the dangers of concentrating financial authority. Yet, after 1907, the weaknesses of the existing arrangement were harder to ignore. If panics could threaten the wider economy, then the country needed an institution capable of supplying liquidity, coordinating reserves, and acting when fear outran the capacity of private men to manage it. This was the world that gave rise to the Federal Reserve in 1913. Its structure reflected compromise as much as theory. Neither a single central bank in the European style, but a federal arrangement with regional reserve banks and a central governing authority. The design itself told a story about American caution. The nation wanted stability without gathering too much power in one place. At its simplest, the Federal Reserve was meant to do something the older system struggled to do. It was meant to help the banking system breathe in moments of stress. Banks hold assets that are often longer term than the deposits against them. In calm periods, this can work well enough. In panic, when everyone wants cash at once, a solvent institution can still become endangered by a sudden shortage of liquidity. A central bank can step into that moment, lending against sound collateral and reducing the chance that fear alone will destroy what time might otherwise preserve. This did not make banking safe from error. It did not remove the business cycle. It did not end speculation, but it changed the architecture. Banking in the United States was now moving away from dependence on heroic improvisation and toward an institutional backstop. The lender of last resort, once more a theory than a reliable fact, had gained a home. There is a quiet irony here. Banking had begun with temples, palaces, and merchant houses, institutions trusted because they seemed durable. Now, after centuries of commercial evolution, modern banking was once again seeking durability in a powerful institution meant to anchor confidence. The forms had changed, but the basic human need had not. People still wanted to believe that when conditions darkened, the system would not simply dissolve. The early Federal Reserve was imperfect and would face severe tests. It was still learning what central banking demanded, and the country itself was entering a turbulent century of war, expansion, contraction, and changing ideas about public responsibility. Yet the creation of the Fed marked a profound shift. Banking was no longer merely a private industry with public consequences. It had become unmistakably part of national infrastructure. Soon enough, that infrastructure would confront the greatest financial trauma of the modern era. A collapse so deep that even central banking, in its early form, would prove tragically inadequate to the task before it. Then came the Great Depression. No history of banking can move past it lightly, because it was not simply a downturn or a sharp panic. It was a sustained unraveling of confidence, credit, employment, and social security on a scale that left deep marks on memory. In the United States and elsewhere, banks failed in waves. Depositors lined up to withdraw money. Loans could not be rolled over. Assets fell in value. What had looked like a financial system became, in too many places, a landscape of locked doors. The causes of the Depression were many and remain debated in detail. Stock market excesses, weak banks, debt burdens, deflation, policy failures, and international strains among them. But from the point of view of ordinary people, one reality stood above the rest. The bank, which had presented itself as a place of order, might no longer be safe. Savings built over years could vanish. Wages disappeared with jobs. Businesses failed. The familiar rituals of deposit and withdrawal were interrupted by fear and closure. This is the point where banking history becomes almost painfully intimate. A run is not only a financial event, it is a human one. It is the hurried walk to the branch. It is the queue outside. It is the closed sign. It is the realization that a number in a passbook may not be retrievable when needed most. In the Depression, that anxiety multiplied across entire regions and then across nations. Confidence was not merely shaken, it was shattered. The Federal Reserve existed now, but it did not yet act with the force, clarity, or doctrine that later generations would expect from a central bank confronting systemic collapse. Banks failed by the thousands in the United States in the early 1930s. The money supply contracted, credit tightened, deflation deepened burdens. The very institution created to help stabilize panic proved in this defining test tragically insufficient. And yet, the Depression also clarified something enduring. Banking stability is not a narrow concern of financiers alone. It is a public good. When banks fail at scale, the damage does not stay inside ledgers. It spills into shops, farms, factories, kitchens, and marriages. It alters the tempo of daily life and the emotional climate of whole societies. The question of how to make banking trustworthy became inseparable from the question of how to make modern life livable. So the Depression became a brutal teacher. It showed what happens when credit systems collapse, when depositors lose faith, and when the institutional safeguards prove too weak for the storm. In its long shadow, governments and regulators would begin reshaping banking not merely to improve efficiency, but to restore belief itself and restore a measure of calm. Out of that wreckage came one of the most important rebuilding efforts in banking history. If panic had shown how quickly trust could die, the next task was to design institutions that might help trust live longer. In the United States, the reforms of the 1930s reflected this new determination. Banking would not be left to recover by mood alone. It would be reshaped through law, supervision, and explicit public guarantees. One of the most consequential changes was deposit insurance. The idea was both simple and profound. If ordinary depositors could be assured that their money would be protected up to a defined limit, they would be less likely to run at the first rumor of trouble. The bank account would become more than a private claim on a fragile institution. It would be backed in part by the credibility of the state. This did not eliminate all risk, but it changed the psychology of banking in a lasting way. At the same time, regulators sought clearer boundaries within finance. The Glass-Steagall Act of 1933 is often remembered for separating commercial banking from investment banking in important respects, reflecting the belief that core deposit-taking institutions should not be too entangled with securities activities. Other reforms strengthened oversight, changed incentives, and tried to build a safer architecture around the public savings. These measures were not merely technical, they were moral and political as well. Society was deciding that banking was too essential to ordinary life to be governed only by private ambition and post-crisis regret. A depositor with modest savings mattered. The family business with payroll to meet mattered. The ability of citizens to trust the place where they kept their money mattered. Stability itself was becoming a policy objective. There is something almost architectural in this phase of the story. Earlier centuries had built the external theater of confidence: columns, counters, solemn halls. Now the 20th century was trying to build confidence deeper into the structure. The visible branch still mattered, but beneath it lay insurance funds, regulators, capital requirements, examinations, and a growing framework of rules designed to prevent old dramas from repeating in quite the same way. Of course, no framework is perfect. New protections can create new complacencies, and every generation discovers that financial risk is inventive. But the reforms of the Depression era changed the emotional texture of banking. For millions of people, the bank became less a place of latent fear and more a stable fixture of civic life. One could deposit wages, save for a home, or keep emergency money aside with a quieter mind. And so, after one of the darkest chapters in financial history, banking entered a new period, more regulated, more supervised, and more explicitly woven into the promises of the modern state. After the Depression and the Second World War, banking entered a calmer age. The branch became a familiar feature of neighborhood life, modest or grand depending on the city, yet generally reassuring in the same careful way. There were counters, polished floors, tellers behind windows, managers in offices, and lines of customers carrying checks, passbooks, and deposit slips. Banking, for many households, no longer felt like a distant world of magnates and panics. It felt like part of the weekly routine. This post-war period was shaped by rising home ownership, expanding middle classes, and a broader culture of saving. Banks and savings institutions became deeply involved in mortgages, household deposits, consumer lending, and the financial stages of life. A first checking account, a car loan, a mortgage payment, a savings bond for a child. These were the rituals through which finance settled into domestic memory. The bank was where adulthood became measurable, and yet the system's calm appearance rested on a dense supporting structure. Regulation was stronger. Deposit insurance had changed depositor behavior. The Federal Reserve had matured. Commercial banking in many countries operated within a more constrained environment than the speculative ages that had preceded it. This did not make the system static, but it did help make it feel predictable. Predictability has a soothing quality. Checks move through the economy in huge volumes, carrying payments without requiring physical cash. Payrolls were deposited, utility bills were settled, small businesses counted the day's receipts and sent them to the local branch. The bank manager, once a more imposing figure, became in many places a professional custodian of routine trust. The system was still abstract beneath the surface, but on the surface it felt stable enough to disappear into ordinary life. This was also the era in which banks helped mediate aspiration. To borrow responsibly for a home, to save for education, to keep a modest rainy day fund, to build a credit history. These became part of the social script of adulthood. Banking was no longer merely preserving wealth that already existed. It was helping households plan a future they hoped to grow into. The story was not without tension. Exclusion persisted. Access to credit and banking services was not distributed equally across class, race, or geography, and that inequality shaped lives in ways too large to ignore. Still, for many citizens in the post-war decades, the bank represented continuity. It was where wages were placed, where bills were paid, and where the future was arranged in manageable monthly pieces. Soon, however, the very familiarity of this world would begin to change. Cards, computers, cash machines, and later digital networks would make banking more convenient, less personal, and increasingly invisible, until the old branch itself began to feel like a memory. The post-war banking world looked calm, but beneath its routine surface, new technologies were already changing the texture of money. At first, the changes seemed modest. Checks became more standardized and easier to process in huge volumes. Clerks, machines, and sorting systems handled streams of paper instructions that allowed salaries, bills, and business payments to move without stacks of cash crossing a counter. For households, this felt like convenience. For banking, it marked a quieter transformation. Value was becoming less physical and more dependent on systems operating behind the scenes. Then came the plastic card. Credit cards and charge cards changed the rhythm of payment. A purchase no longer required money already resting in the hand. It could be made against future income, future discipline, and future confidence. Credit had always existed in one form or another, but the card made borrowing more immediate, more portable, and more woven into daily life. Banking became something people carried in a wallet, ready at a restaurant, a department store, a petrol station, a hotel desk. With that shift came a subtle cultural change. The bank was no longer only a place where money was stored or wages deposited. It became part of consumption itself. To spend and to borrow moved closer together. Convenience expanded, but so did the possibility of quiet accumulation. A balance rolled forward, interest compounding, the future entering the present in small swipes and signatures. The automated teller machine deepened the change. The ATM was both practical and symbolic. It loosened banking from the fixed hours and rituals of the branch. Money could be summoned from the wall late at night, on weekends, in airports and shopping centers, almost anywhere a machine could be connected to a network. The teller window, once a defining image of banking, began to lose some of its monopoly over access. Behind all of this, computers were taking on a larger role. Ledgers that had once lived in bound books or paper files increasingly migrated into electronic systems. Accounts could be updated faster. Payments could be reconciled more efficiently. Large institutions could coordinate information with a speed earlier bankers would have found astonishing. Yet the transformation remained oddly invisible to many customers. What they noticed was simply that money felt smoother, quicker, and a little less material. By the late 20th century, one could already sense the old branch-centered world beginning to recede. The building still stood, and the routines still mattered. But banking was slowly detaching itself from place. The future would accelerate that separation, carrying finance out of neighborhoods and into a denser, more global, and more complex architecture of markets and networks. As banking detached itself from the old neighborhood branch, it also became harder to see in full. By the late 20th century, the system was no longer defined only by deposit-taking banks making straightforward loans and waiting patiently for repayment. Deregulation in several countries loosened old boundaries. Capital moved more freely across borders. Markets deepened. Institutions merged, expanded, and discovered new ways to package, fund, and distribute risk. Banking was becoming less a single industry than a layered ecosystem. This did not mean the disappearance of ordinary banking. People still opened checking accounts, took out mortgages, deposited paychecks, and spoke to branch staff. But beneath those familiar routines, finance was growing more intricate. Banks borrowed in wholesale markets. Securities firms and money market funds became more significant. Assets could be bundled, sold, hedged, and refinanced through structures that made the old image of a bank vault seem almost quaint. The visible branch was now only one room in a much larger building. Globalization intensified the process. A bank in one country might fund itself in another currency, lend into a third market, and be exposed to events far from its headquarters. International capital could support growth and efficiency, but it could also transmit stress. Trouble in one region could travel quickly through balance sheets, confidence, and funding markets. Distance, which banking had spent centuries learning to master, was now compressed by screens and telecommunications into something nearly immediate. There was great elegance in this architecture. Risk, in theory, could be spread more widely. Savings in one place could finance opportunity in another. Companies and households could access deeper pools of capital. Financial engineering promised flexibility and precision, but elegance can conceal complexity, and complexity can conceal fragility. The more layers that intervened between a saver and the ultimate use of funds, the harder it became to know exactly where risk was sleeping. This was also an age of competition, leverage, and return-seeking. To be modern was to be faster, more market-connected, more quantitative. The language of finance grew dense with models and acronyms. Yet beneath the technical surface, the old human pattern remained familiar. Institutions still depended on confidence. Borrowers still depended on rolling obligations forward. Markets still assumed that liquidity would be there when needed. Banking had spent centuries trying to escape the inconvenience of physical money, local information, and slow settlement. It succeeded beyond anything earlier ages could have imagined. But in doing so, it built a world that was at once more efficient and more difficult to understand. The system had become global, electronic, and highly adaptive. It had not become immune to fear. The road to 2008 was paved not by one reckless act, but by layers of confidence laid on top of one another. In the years before the crisis, credit was abundant, interest rates were supportive, and faith in financial engineering ran high. Housing in the United States seemed, to many, not merely a market, but a foundation of household wealth. Mortgages were issued in huge quantities, including to borrowers whose ability to repay was more fragile than the surface suggested. Yet the system did not stop at the loan itself. It transformed loans into securities that could be sold, rated, financed, and spread throughout the financial world. This process, known as securitization, had a practical logic. A mortgage held on one lender's books tied up capital and concentrated risk. If many mortgages were pooled and sold to investors as mortgage-backed securities, funds could be recycled, new lending could continue, and risk, in theory, could be distributed more broadly. In moderate form, this was not madness, it was a technique. But techniques grow dangerous when treated as guarantees. Around these securities grew another architecture often described as shadow banking. The term refers to forms of credit intermediation that performed bank-like functions without always being regulated like traditional banks. Investment banks, money market funds, repo markets, structured vehicles, and other institutions helped fund long-term or risky assets with short-term, confidence-sensitive borrowing. It was a familiar pattern in a more modern costume. The danger lay in leverage and trust. Many participants assumed that housing prices would remain supportive, that models had dispersed risk safely, and that short-term funding markets would keep functioning smoothly. Ratings offered reassurance. Complexity created distance. Distance created complacency. It became possible for institutions to hold exposures they did not fully understand, financed in ways that looked stable only as long as confidence held. When U.S. housing prices weakened and mortgage losses began to rise, that confidence started to fracture. Questions emerged about valuations, collateral, and who was exposed to what. Instruments that had seemed liquid became hard to price. Funding markets tightened. Firms that relied on rolling over short-term borrowing discovered that tomorrow's money might not arrive. The logic was ancient, even if the instruments were new. A banking system built on confidence can seize when confidence retreats. What made 2008 so consequential was that it revealed how much of modern banking had migrated beyond the old deposit-taking model into a wider network of hidden leverage and contingent trust. The run had not vanished from history. It had merely moved. Instead of crowds gathering outside a local branch, panic now raced through wholesale funding markets, repo agreements, balance sheet marks, and screens glowing late into the night. When the crisis fully broke in 2008, governments and central banks were forced into extraordinary action. Major institutions failed or were absorbed. Emergency lending facilities expanded. Guarantees were offered. Capital was injected. Interest rates were cut sharply, and in some places pushed close to zero. The old lesson returned with brutal clarity. Banking stability is not a private luxury. It is part of the operating system of modern life. And when it breaks, the damage spreads far beyond finance. In the aftermath, regulation tightened. Capital requirements were raised. Liquidity rules became more demanding. Stress tests sought to imagine what severe downturns might do to large institutions. Supervisors paid closer attention to interconnectedness, wholesale funding, and the hidden channels through which trouble had spread. The aim was not to abolish risk, because that is impossible, but to force more resilience into the structure before the next storm arrived. And yet, the world did not simply retreat into an older form of banking. Even as oversight became stricter, the daily experience of money grew more digital. Mobile apps replaced branch visits. Online transfers replaced paper instructions. Phones became wallets, statements, alerts, and miniature control rooms for household finance. A person could move funds, pay rent, split a dinner bill, or review a portfolio while standing in line for coffee. Banking had become more immediate, more intimate, and almost weightless. Fintech firms entered with fresh interfaces and narrower specializations. Some offered smoother payments, others cheaper transfers, faster underwriting, budgeting tools, or alternative lending models. Traditional banks adapted, partnered, competed, and learned. The customer increasingly encountered banking not as a solemn institution, but as a sequence of taps, passwords, biometric checks, and glowing notifications. Trust was still there, but it had been translated into design, encryption, and uptime. There is something remarkable in how quickly this felt normal. The history we have traced moved from clay tablets to Renaissance ledgers, from goldsmith receipts to checkbooks, from marble branches to ATMs. Now the bank could live almost entirely behind glass. A screen, an app, a code, a server farm somewhere out of sight. For many people, cash itself became occasional, almost ceremonial. Still, the post-2008 world never fully escaped old anxieties. Periodic bank failures, liquidity scares, and sudden reminders of interest rate risk showed that even highly regulated systems remain vulnerable to mismatch, concentration, and fear. The language changes, the interfaces change, the speed changes, but confidence remains the quiet substance from which banking is made. Technology can make trust more convenient. It cannot make trust unnecessary. And so we arrive at the present, where banking can feel almost invisible. Salaries arrive by direct deposit without a check ever being touched. Bills are paid automatically in the background. A phone can summon a balance, move money across borders, approve a purchase, or unlock a digital wallet in a second. For some, this feels like progress so smooth it barely asks to be noticed. For others, it carries a faint unease. If money is now mostly numbers moving through distant systems, what exactly are we trusting when we trust the bank? That question has taken on new forms in recent years. Cryptocurrencies emerged with the promise, or at least the aspiration, of moving value outside traditional banking structures. They invited people to imagine money secured not by a familiar institution, but by code, distributed networks, and new rules of verification. At the same time, central banks around the world began exploring digital versions of official money, sometimes called central bank digital currencies, asking whether the state itself might one day issue forms of value designed for an increasingly electronic age. Whether these experiments transform everyday banking or remain more limited, they tell us something important. The ancient problem has not gone away. We are still trying to answer the same questions that haunted the temple storehouse, the Florentine ledger, the London bond house, and the modern branch. How should value be stored? Who should verify it? Who should stand behind it in moments of doubt? How much trust belongs in private institutions, how much in public ones, and how much in systems that claim to rely on neither in the traditional sense? Perhaps that is why the history of banking feels so strangely calm and restless at once. It is a history of innovation, but also a history of recurrence. New instruments appear, new names rise, old buildings disappear, screens replace counters, and yet the emotional structure remains familiar. We still fear loss. We still prize reliability. We still build elaborate systems to bridge the vulnerable space between today and tomorrow. Luca Pacioli brought order to the books. Rothschild showed how trust could travel across capitals. J.P. Morgan stood in the breach when panic outran structure. The branch manager, the clerk, the coder, the regulator, and the person checking a balance at midnight all belong to the same long story. Banking has always been a method for preserving confidence across time. So tonight, as the world grows quieter, perhaps banking can be understood in its simplest form, not as jargon, not as towers, not as markets flashing on a screen, but as a very old human hope that what we save, promise, lend, borrow, and build can endure the night and greet us again in the morning. The world slows, and so do we. Good night.